how has COVID changed AllianceBernstein's view on the longer term economic outlook? And we first want to go there, and then I want to talk about what we're seeing in the elevated price to earnings ratios on stocks, and where are you guys looking at, and how do you think this is all going to end?
So first question, Dean, that I will take, and you sort of alluded to this again earlier, is why AllianceBernstein's relative performance has been so strong, not just the last couple of years, but specifically last year. And to us, the way we think about what COVID really did was COVID again accelerated a lot of trends and themes that had already been set in motion. So I'll give you one. We had been sort of early investors in a lot of the innovation around healthcare, and specifically genomics and personalized or sequencing of medicine. And one of what I call the picks and shovels ways that we had been investing for this was investing in companies that were going to benefit from more and more clinical trial testing. That basically companies that had large moats around that trend or theme. And what happened last year, right? We had literally a moonshot, a global public-private partnership equivalent to a modern-day moonshot of trying to get both vaccinations for COVID, but also therapeutics. And who benefits from that? These companies that again were poised to grow from all these dollars chasing clinical trial testing. That's one small example. I could literally probably list 10 others, but whether it's electric mobility or electric vehicles, whether it's digital payments, the growth in PayPal and Square relative to cash, or calling the rise of cashless commerce, that was a term we had pre-COVID. All COVID did was drop basically brought a match to all the gasoline that had been built up. And so, yes, have we been prepaid now? Probably some of this future growth, and it's why the returns were so good. Absolutely. And it's also why multiples on a lot of these stocks have gotten elevated, some justifiably, but others maybe a little too much. Maybe
that's interesting. It's interesting. And I remember you and I talking about this in the podcast back in the summer of 2019, and how you guys were looking for some of those macro trends. And the interesting thing about how you invest that way, though, and when you identify these companies and you decide, okay, this is a company that we want to own, you may not get the payoff that year or even the next year, right?
Correct.
And so in some cases where you're investing in things that may take 2, 3, 4, 5 years before that really matures, and then you start to get the great returns, people can get impatient.
Yes.
And they, especially in today's society, we get impatient. Man, this thing hasn't performed for the last 3 weeks, Dean. What the hell do I still own it for? And you and I know that there are fundamental reasons behind owning the things that we own. So how do you get people through that? And then how do you get people to get rid of the emotion on the investing side of things? Because I think that there was a ton of emotion around investing last year, and there was a lot of people that just said, I don't want anything to do with the market. And yet the market's wound up with a banner year on top of a banner year in 2019. And there was a lot of people that sat on the sidelines and didn't participate.
Mm-hmm. It's a great question, Dean, and that's why I joke. That's why Dean Barbers of the world exist, because as you know, probably half of your job is being that client's behavioral finance psychologist.
Yeah, it is.
Talked about the necessity of that personal financial plan and how performance is always beholden to the plan. And one of the quotes I used before, and it's as relevant as ever, is that in the absence of knowing what's enough, the alternative is always wanting more return, more performance. And that is, I think, if you don't solve for that initially as an investor working with a financial advisor, you continuously set yourself up for failure. I'll give you one stat that still shocks me. I almost have to do a double take when I see it, is that since 1988, the stock market's average over kind of 3-year rolling periods, which is kind of a typical, we sort of assess things when we own a company, want to own it for at least 3 to 5 years. It's averaged around close to 11%. But if you missed just the best 5 days in those 3-year periods, you know what your return goes down to instead of 11%?
maybe 2 or 3?
4%.
4%.
4%. You've been better off holding a boring old municipal bond fund and just let it. You actually would have earned a little bit more in a municipal bond fund. So this gets. I mean, there's been Nobel Prize winning economists that have studied this. Daniel Kahneman and Amos Tversky and others. And that's the $1 million question. But I go back to that's if you are investing without a purpose, then you are probably setting yourself up for failure. And 2020 was a microcosm of that.
Don't forget to like, share, and subscribe if you haven't already done so. And feel free to give us some comments below. If you want to watch this entire episode, you can find the link here on the screen or in the description below. Thanks for watching.
Starting your route to retirement.